Let us move now to another company which is on oil traders' radar. This is Tower Resources. It's an oil and gas company with a pan-African regional focus, preparing to drill in the Thali block in shallow water in offshore Cameroon. And we have Jeremy Asher. He is the chairman and CEO. He's got very broad experience of the industry, from being deputy chairman of the fully listed Gulf Keystone to years as a management consultant and running global oil products trading at Glencore. So these are top companies. So let us hear from him.
Thanks very much. As Nigel said, Tower is an oil and gas company with a focus on sub-Saharan Africa, and we have a history as an exploration company, which is why we still have some exploration licenses, notably in Namibia and in South Africa. But our main focus at the moment is in Cameroon, where we have an asset which is in development, which we're aiming to bring into production in the next 12 months. So that's our main focus, and that's also going to be what I'm going to talk about the most in the next 15-20 minutes. The license that we have in Cameroon, it's called the Thali license, is actually an exploration license because there's a lot on it still to explore, as I'll explain to you. Nevertheless, it has an existing discovery on it, and that discovery already has 18 million barrels approximately in contingent resources, with as much again in prospective resources just on that structure alone. Right now, as part of the process of exploring the block, we're also simultaneously going to develop that asset, bring it into production, and we want to do that as quickly as we can. To give you an idea of the scale of the prize, well, you probably already have a good idea because you're all seasoned investors of the value of contingent resources, but the EMV10, according to the reserve report of the contingent resources we have, is order of magnitude $118 million, which is in accordance with the kind of metrics you'd expect for contingent resources, with a similar amount, again, potential value in the prospective resources. In other words, it's something of value that we're aiming at, and right now that's the most important thing for us, with the exploration aspects of the block, which are also very significant, but really pure upside. So having said that, let me show you where the Thali block is. For those of you who are not so familiar with Cameroon, Cameroon sits kind of at the corner of the Gulf of Guinea, with Nigeria as its big brother to one side, and Equatorial Guinea to the south. So it's a very petroliferous zone. There's a huge amount of production, obviously, in Nigeria, also now Equatorial Guinea is quite an oil province. Cameroon's been producing oil for years, but lately the production in Cameroon has been declining, as it has in many places because of a relative underinvestment. To put that in perspective, Cameroon produced over 100,000 barrels a day until quite recently. Right now, production's down around 70,000 barrels a day, most of that being produced by Addax and Perenco. The good thing about that is that there's a lot of infrastructure available. Not that we necessarily need it, because we're offshore in the shallow water, and in the shallow offshore, actually, you can be pretty self-reliant if you want to. But you can see on this chart here the amount of the infrastructure operated by Perenco and Addax around us, all leading mainly to the Masongo terminal, which you can see in the bottom left. And the Masongo terminal is a floating FSO. They have two different grades of crude that they blend to and sell out of there. And we're quite close to all of that infrastructure. But at the same time, the infrastructure is also potentially going to grow further, because if you look at the right-hand side of the chart, you'll see the Dasoni North field, which is immediately to the north of our license, and that's not a coincidence. And then over to the east of that, you can see the Oak discovery, which Glencore made a few years ago and is now operated by Perenco as a joint venture between Perenco and Glencore. And that also is under development at the moment, and there'll be further pipeline extension over there. So our block is immediately to the south of Dasoni and quite close, as you can see, to all this infrastructure. The Thali structure, that we're most interested in is called Njonji. And that's the one that you can see towards the lower part of the structure, and I'll zoom in on this in a second. But you can also see from this map why we're very interested in the structures which are still undrilled in the northern part of the license, which are right next to the Dasoni North discovery, and also are very much on trend with Oak. The history of the license was that originally it was a Total license, and well, in fact, even before that, it had been Pecton, Shell had it. But Total did most of the recent work on the license, and they drilled, at the time, the license included Dasoni North. It was all called the Dasoni license, and Total drilled 6 wells on the license. 2 of them were discoveries, discovering oil in this Njonji structure in this sort of southern area. And then they also made a shallow gas discovery, which is, to us, not particularly relevant. And they made 3 wells in the northern part of the license, which uncovered the Dasoni North field. But the whole thing was sort of tiny for Total, and Total made the decision around 2010 to disengage from Cameroon. They sold out to Perenco. Perenco took over this license, which at that time was the very end of an extended exploration period, and so they had to choose what to keep and develop and what to relinquish. So they chose Dasoni North, which was the simpler of the 2 structures, and they said, right, we're going to develop that. And they relinquished the rest of the license in around 2013. And that was how it was that we were able to acquire it in 2015. Now, the Njonji structure, Total knew that there was oil there. I mean, they tested while drilling, but they hadn't done flow test to surface. And their original theory as to what was going on in the structure, which was based on quite old seismic, 3D seismic, but quite old data. It took a little bit of a bang when they drilled the second well, Njonji 2, also finding oil in the same reservoirs, but also establishing clearly that there was a sealing fault separating those 2 parts of the structure. And it made it difficult for them to be sure of what else was going on inside the structure. What we did when we took over the license, the original plan had been to acquire new 3D, but that rapidly proved to be impractical with the problems that the industry was having in 15-16, because we'd originally been planning to do that work together with other work done by other operators around us, and there were vessels around. All of a sudden, no one was doing anything, and there were no vessels. So we agreed with the Cameroon government that we would instead reprocess the existing 3D, which, as I said, is quite old vintage. So we expected and received a very significant uplift in the quality of that old 3D, and then figure out what to do next based on that. We got that information last year, and what it told us was quite interesting. We could see clearly the sealing fault. We could also see another baffle-type fault, which sealed at the level of the lower reservoirs, because they're stacked reservoirs here, but not at the level of the upper reservoirs. And that's why, if you are looking closely at the picture, you'll see the sort of green blob on top of a sort of a red blob. And the reason is literally because the upper reservoir, we already know, extends across the whole structure. And that's why we've got 18 million barrels of contingent resources. But in the same structure underneath the lower reservoir, we know it's there in the upper part of the structure, the northern part, but we don't know whether the southern part of it, which is considerably larger, is actually oil-bearing. So that's why we have another 18 million barrels. These are all P-mean resource numbers. Could be more, could be less. but there's another 18 million barrels potentially in the lower reservoirs in the southern part of the structure. The only way to find out how much oil is there is to drill. So that's what we're planning to do, and that's why the well that we're drilling is called Njonji 3, because there's already 2 wells already drilled on the structure. But in fact, from our point of view, it's the first potential production well, but it's a bit of all 3 things. It's an appraisal well and an exploration well as well, because we haven't got really good flow data at all. Total never did a flow test. And what's more, we also think now, seeing what we now see, that the reservoirs thicken to the south, and there'd be maybe some things already a little bit further south in the structure, which may also be potential reservoirs as we sort of move a few hundred meters down to the south. So the work plan that we're actually undertaking is, first of all, we're going to drill the first well, and then we're going to take a pause. The first well is being planned both with the exploration objectives in mind, but also as a producer. We'll then mobilize and install a MOPU. We're choosing a well location that we think is not just a good well location as a producer in this section of the structure, but also as a good point from which to drill further deviated wells around a simple structure, so that we can put as many as 4 or 5 or more wells from this one location into different parts, both of the northern part of the reservoir where we already know what we've got, and also to test into the deeper parts of the southern part of the structures where, as I've said, we don't know if the reservoirs there are oil-bearing and have the same oil-water contact and so forth. So the idea is to do all of that without having to make further investment in costly infrastructure under the water on the surface. We're in fairly shallow water here. It's only about 30 meters. Costs are generally pretty low. Even so, the moment you start mobilizing vessels to do pipeline work, you immediately incur a lot of fixed costs. And therefore, it's something that we don't want to do until we really have a good need to do it. And then we'll do all the pipeline stuff that we want to do. Until then, we're trying to minimize the amount of work on the subsurface and put ourselves into a position where we can have several wells producing into a MOPU and have a significant production operation without having to make those surface investments. Now, the amount of production we can expect from each well, this is one of the key things that we're going to determine with this first well. The typical flow rates for wells in the Rio del Rey in Cameroon range from 1,500 barrels a day up to about 3,000 barrels a day. But it's really very hard to tell what we're going to find because, first of all, most wells in this area are accessing multiple reservoirs anyway. Secondly, the specific reservoirs that we have in this particular structure are not the same as the ones in the Jadestone field immediately to the north, so we can't rely on that as an analogue. I wish we could, because the Jadestone wells flowed over 3,000 barrels a day initial flow rate and have been performing well with, they've been using injection to sustain production since they started. We will have to see how these wells perform. So the way we're structuring what we're doing is as an extended well test while we continue to also conduct other exploration on the block. The beauty of doing that is that extended well test is still production by any other name, and we get our share of the production and the cost recovery just like we would if we were already in field development under the terms of the production sharing contract. However, by doing it while we're also still in the exploration phase of the license, it also means that we can continue to do other exploration work on the license, and the cost of that work is still part of the same single cost recovery pool. So that means that the risk of that further exploration work on the license is massively reduced. I mean, it's really almost nothing because the rate at which you recover costs is so fast on a project like this that effectively we'll be recovering the cost of any further exploration wells we drill in less than a year. The kind of mobile offshore production unit that we're planning to deploy is very standard in West Africa. In essence, the standard way to do it is you take a cold stack jack-up rig and you convert it. The jack-up rigs are available for a few $100,000, so it's a matter of taking it to a yard, buying skid-mounted process equipment, and putting it onto the platform. And then you use that platform as a production platform, and that's exactly what Perenco did just to the north of us in Dissoni, and it's done throughout West Africa. So this is a relatively straightforward operation and not hugely expensive. Having said not hugely expensive, there's no such thing as cheap in our business, so it's all very relative, and I'll talk about those costs in a minute. If this is successful, and in particular if the well into the southern part of the Njonji structure is successful, then that would just be the end of phase one. We'd then do a second phase, probably around a second hub in the southern part of the structure, and drill several more wells. But our hope is to get to 8,000 barrels a day of production off of the first phase, and then go from there potentially to 16,000 barrels a day or more, and probably all just using the one MOPU. The prize is substantial. The best estimate MPV10 of the contingent resources, those 18 million or so barrels, is actually 158 million. The EMV10 of 118 is based on a complicated formula which I'm not sure is particularly relevant. The key thing, though, is that those numbers all take into account the cost of development. So the point is you put the money in for that phase one of development, and just the phase one alone will then be worth what you put in, which Oilfield International estimate as being close to 80 million. And then, if all's gone to plan, you have $240 million of value on the other side. So the net present value is about 158 million, but that means that the sort of ratio of what goes in to what comes out is very attractive, and the potential value of what we'll have once we've undertaken that phase one of development should be very attractive. And then there's potentially as much, again, in the prospective resources in the southern part of the license. And as I mentioned, there's also a lot of prospectivity in the north, but with the limited time we have, I'm not even going to dwell on that. Now, the real question is, how do we finance the phase one of the development? If you look at the cash flow impact in the reserve report, and we're using that not because we think that's our own personal base case of what's happening, but simply because it's in the public domain and it's an independent view of the economics of the project. Oilfield International estimated it'll cost us $78 million to do this. I think those numbers are a bit high. The key assumptions underneath that are $20 million for the first well we're drilling now, including testing, and $15 million for the subsequent wells. And then he's got an amount in there for platform and other infrastructure. The actual AFE on the well we're drilling now is a little under $15 million. And of that, the dry hole cost, what we'd expect to be paying for the subsequent wells is close to $10 million. This first well is costing quite a lot more because we plan to do a fairly extensive testing program on it, which we won't be needing to do on the subsequent wells. So I do think that the number that we're actually going to need to finance in order to bring 4 wells into production with a MOPU is going to be rather less than $78 million, but still probably $50 million plus. So the big question that most investors have is, well, how are you going to finance that? Because your market cap at the moment is less than $10 million. And the short answer is we do believe debt financing should be available. When you look at the cash flow that's coming out of these assets, and this is just phase one, this is assuming no none of the prospective resources are there, just based on what we know is there. You're looking at $100 million plus a year. That allows you to amortize debt pretty fast. It allows you to service debt. It means that, you know, we should be a kind of no-brainer for reserve-based lending once we're in production. The trickier part is to get your financing pre-production, and that's what I'm working on at the moment and have been working on for the last 6 months. It's a more specialized market. It's not as easy as just walking up to, you know, one of the well-known group of reserve lending banks and, you know, asking for a reserve-based loan. So I understand why people worry as to whether or not we can do it, but I'm pretty confident that we can. That's what we're working on at the moment, and that's the main risk that investors face in the company. There's also the usual risks of nature and so forth, but this is the key to what we're about. We need to raise a bunch of money fairly shortly if we're to meet our schedule of getting into production by this time next year. But if we can do that, the prize is enormous, and the value of the company will be a whole order of magnitude different from where we are now. And it's really as simple as that. I'll talk just for a moment before I finish.
Just another minute or so.
Yes, about South Africa and Namibia. But South Africa is a license that we hold in joint venture with New Age. It's operated by New Age. There's 3 basins down there in the license. And the most interesting one at this moment is actually the Utinikwa Basin. Gamtus and Algoa have been the basins that we've concentrated on in our work with New Age until now, because they're shallower basins, easier to develop if we had to do it on our own without a big partner. And we've done extensive 2D on one basin, 3D on the other, have drill-ready prospects, all very nice. But we were waiting on the prospect in the Utinikwa to see what happened with Total's Brulpada well. As many of you will know, Brulpada came in as a success, gas condensate discovery, about 1 billion barrels BOE, with more around it. Total are very excited about it. And we have a Deep Albion Utinikwa Basin prospect that's similar, smaller, looks like about 360 million barrels, but obviously greatly de-risked by the success of the Brulpada well. So we've been waiting on that before deciding what to do next with the license, and now we've got a farm-out process underway. But obviously we're quite excited about it. We also have a long history in Namibia. We have a new petroleum agreement we've just signed covering blocks that we already know from years ago, and they're very good blocks, but this is pure exploration. I won't say a lot about it except to say, number one, that we do think we had an early choice of blocks, and we've got some of the best blocks in Namibia, we think. But also, the other thing is, because of the fact that we were first, we've already gone through a decade-long process of exploration, culminating in a well that we drilled mainly with Repsol's money, and Repsol operated it, which was not successful, but from which we learned something. But because we've done that, we're now back at the beginning of the process. So nothing more is really expected from us for a while, whereas other people who started later have still got well commitments, which is why there are going to be a number of wells drilled over the next couple of years. And before we do anything more right now than further desk work on the data that we already have, we'll have some other interesting data points from people around us, including Exxon, who've got wells to drill in the next year or two. So that will shape our work program there, but we have no liability there. We don't have a lot of money to spend. That's basically it. So the key point, I'm going to skip over the team, is Cameroon's what we're all about at the moment. We have our legacy, so we have South Africa and Namibia as well. What we've got in Cameroon is something quite valuable, 18 million barrels of mean contingent recoverable resources, something more than $100 million in potential value.
Thank you very much indeed, Jeremy. So, very different proposition to Jadestone. Clearly lots of things going on various fronts, but it all needs investment. So what are investors' thoughts on all this? Any questions?
Question at the front.
At the front here, yes.
This is a very quick question. In terms of sort of things like tie-ins, and do you have any sort of anything in place in terms of sort of to be able to tie in
to existing infrastructure?
Yes.
Yes.
To integrate, to sort of make it more efficient in terms of moving forward.
Well, the interesting thing about tying in, it's obvious that we're very close to the existing Perenco ADAX infrastructure. So it's obvious that in an ideal world, a relatively simple thing to do would be to tie into that. However, there are a couple of factors that we need to bear in mind. The first is to do so would imply a pipeline. And as I mentioned, one of the problems is that it's actually rather a short pipeline. So you might say, well, gee, I mean, that's going to be very cheap, isn't it? Yeah, but per kilometer, if that's the only pipeline you're doing, that looks quite expensive. So, and the second factor is, when you look at the prospective resources, which I didn't spend a lot of time on, but you know, those structures in the northern part of the license are potentially considerably bigger than Njonji. Now, are those, of course we're going to drill holes in those, assuming everything works as planned. And if those have oil in them, then of course at that point we'll have a more elaborate field development to consider, taking those into account. And that's the point at which we'd be planning the pipelines, because then we have an idea of what's got to go where. Now, until then, we don't really particularly want to get involved in pipelines. The second factor, anyway, is that even with the MOPU, without a pipeline into the existing infrastructure, we'll have a shuttle tanker, and we can go and shuttle the oil back and forth to the Masongo terminal anyway. We'll probably want the shuttle tanker there anyway for storage. We can put some storage into the MOPU, into the legs, but we'll probably use the shuttle tanker anyway. So the shuttle tanker will be there. So the cost of taking it over to the Masongo terminal is only fuel cost, which is not that great. And finally, using the Perenco infrastructure, of course, does require the agreement of Perenco. Now, Perenco have actually been very supportive to us so far, very friendly, helpful in terms of potential use of equipment and so on and so on. But, you know, they're not a charity, and obviously they'll look to get some economic rent from the infrastructure they've already built. So there may come a point where it makes sense to pay Perenco to use their infrastructure. It may be that we're better off just building our own pipeline. If we've got pipeline laying vessels there anyway, it may be better just to build our own infrastructure. We'll just have to see.
Can you just briefly compare and contrast? We heard the case from Jadestone previously, where they made it very clear that they're not interested in exploring. That's just not the model that works for them. But they're also, you know, still at the phase of trying to interest a wider range of investors. Do you accept your proposition in a way? It's different, but it's almost even more difficult, because you've also got to, people have got to take a lot more on trust, if you like. Well,
I think actually it's not that different. I think it's very complementary, but you know, the thing is that you start from where you are. Now, where we started was as an exploration company. Now, one of the conclusions we came to in 2013, 2014, when we were drilling a very high impact well with Repsol, was that we really needed to diversify the portfolio and what we were doing. And that was why we set about this whole process of building this business in Cameroon. And I won't bore you with all the details of why Cameroon, how we did it, and so on. But the whole idea was we wanted production. Now, lots of people wanted production, and they still do. But the problem is that if you just wander out there saying, oh, I want some production, so I'm going to pay top dollar for it. And remember, 2014 was top dollar. And if, in addition to that, you say, oh, and I'll borrow some money for it too, you know, you're really inviting disaster. The best way we felt to build production was to actually learn how to operate and do it and get our production with the drill bit. Now, that's a lot. All of these things are much easier said than done. So we had some knowledge of what was going on in Cameroon because of the people we had in the company and the people we were bringing in. We felt that that was a viable route, so that's what we set about doing. The fascinating thing about this license, which many people overlooked, was because it was called an exploration license, people ignored the fact that there was a discovery on it. And also we felt that Total had originally been very optimistic about this Njonji structure and then kind of got a sour taste in their mouth after Njonji 2 and didn't really, they sold it very shortly afterwards. So no one had really looked carefully at what had been done with it. But the whole point of what we've been trying to do is to build a production base. Ultimately, that's the point of the oil business. I mean, no point exploring if you never put anything into production. And cash flow is what we invest for. And I'm a big investor in Tower too, so I also had limited appetite for exploration as a source of amusement. You know, the idea is to get to production. And so we thought that's what we have to do. Now, it's a long-term project. We've been at this now in Cameroon since 2014, so nearly 5 years already. And it'll be another year or so before we get to production. But this is how you pay your dues, and this is how you build a business, which is what we're trying to do.
So, Paul, maybe you're not quite as different in some ways then.
I mean, if I look at the portfolio here, you know, I mean, what I see here is you know, low risk resource, close to infrastructure, proven hydrocarbon provinces, and shallow water, and therefore, you know, not too expensive to develop. So, you know, I mean, in many ways, if something like this was in Asia Pacific, we might even look at it. The exploration
move it.
Yeah. the exploration component, you know, in the other licenses we wouldn't. But I think the focus on this seems to be pretty sensible.
And the thing is, when you've got these relationships like we have in Namibia, I mean, a decade, there's something of value there, and you're very reluctant just to throw it away. But we're also very cold-eyed about it. We're not just going to take millions of dollars and throw them into Namibia because we have a past there. We're looking at that as an asset which we want to try to take advantage of. And it's the same thing in South Africa.
Well, thanks very much indeed. We're out of time there. That's Jeremy Asher, Chairman of Tower Resources.